It is after midnight, and Brent is racing toward $120 a barrel. Not next month, not in some abstract forecast. Right now, and you realize the bombs are no longer the whole story. The real danger is transmission. A strike lands near a tanker route in the Gulf. One ship turns back. Another captain cuts speed. Insurers reprice by the hour. On your screen in Washington, the Strait of Hormuz looks less like a waterway and more like a clogged artery. If this keeps spreading by morning, if traders decide the blockage is real before the next market open, then the war will not stay in the Gulf. It will hit gas stations, inflation expectations, bond yields, and then American households. You are Scott Bessent, sworn in as the 79th U.S. Treasury Secretary on January the 28th, 2025. You do not watch this like a general. You watch it like a markets man. Flows, freight, risk premium, the 10-year yield, the little red numbers crawling across a monitor before the rest of the country has had coffee. And that is what makes this so brutal. Because you helped build the pressure machine that got you here. On February 4th, 2025, the White House issues National Security Presidential Memorandum 2, Maximum Pressure on Iran. Treasury says the goal is to drive Iran's oil exports to zero. On February 24th, you sanction more of Iran's shadow fleet, the shadowy network of vessels, shippers, and brokers that keeps its crude moving. On March 6th, at the Economic Club of New York, you make the doctrine plain. Sanctions will be used explicitly and aggressively for immediate maximum impact. You mean every word. Iran's economy is already buckling. You point to 35% official inflation, a currency down 60% in 12 months. You say the campaign is designed to collapse Iranian oil exports from roughly 1.5 to 1.6 million barrels per day. On April 2nd, you say Treasury is targeting every stage of the chain: extraction, sale, shipping, settlement, not just the barrel. The bloodstream. For months, that is the mission. Treasury names ships, brokers, shell companies, middlemen, Lydia Tud, Aden, Fiona. Dry names. Technical work. But to you, this is warfare by spreadsheet and blacklist. Economic security is national security. Then February 28, 2026 happens. The US and Israel strike Iran, and suddenly the campaign stops looking neat. Now the battlefield sits beside the single most important oil choke point on Earth. The Strait of Hormuz carries about 20 million barrels of oil a day. In 2025, roughly a quarter of the world's seaborne oil trade. And the backup routes are a joke against the scale of the problem. Only about 3.5 to 5.5 million barrels per day can bypass it by pipeline. If Hormuz seizes up, spare capacity offers no comfort. Oil that exists on paper is useless if it cannot move. Then the International Energy Agency delivers the phrase that should terrify any Treasury Secretary: the largest supply disruption in the history of the global oil market. Flows through Hormuz fall from around 20 million barrels per day to a trickle. Gulf production drops by at least 10 million barrels per day. Brent surges to within a whisker of 120 years. You can almost hear the chain clicking into place. Phones buzz, screens refresh. Shipping maps fill with gaps where normal traffic should be. Tiny vessel icons wink out into dark transits. Lloyd's List. Intelligence says many crossings are now dark. AIS signals gone. Oversight evaded. Meanwhile, the room is too cold, the coffee has gone bitter, and every minute you wait risks the same thing. By the next US trading session, the market may decide this is not a scare. It is a regime change in supply, and if that thought hardens, the damage spreads fast. A missile lands near the tanker route. The tanker does not sail. Oil jumps. Gas stations reprice. Consumers flinch. Inflation expectations stir. Bond yields harden. And the war arrives in kitchens, carpools, and mortgage payments. Most people will never see the chain. They will not read the IEA report. They will not care that Hormuz also carries almost 20% of global LNG trade. They will not think about stranded Saudi spare capacity or shipping insurance or refinery feedstocks. They will just see the gas station sign change overnight. Maybe they hear the click as the numbers roll up a few more cents before the nozzle goes in. Maybe they stand there doing the same math they always do: commute, groceries, rent, one more week. And you know that pain is political long before it becomes theoretical. In 2025, you acknowledged what voters really feel: the grocery store, the price at the pump, insurance, housing, rent. That is the trap. You spent a year trying to choke off Iranian barrels. Now the market is telling you those barrels still matter. Worse, the market is mocking the whole idea of control. Even as normal shipping collapses, some oil still slips through. AP reports that between March 1st and 15th, only 89 ships cross Hormuz, including just 16 oil tankers, down from roughly 100 to 135 daily passages before the war. And yet Iran still exports well above 1.6 million barrels of oil since the beginning of March, according to Kepler estimates cited by AP. So the pressure campaign is colliding with two ugly facts at once. First, the world still needs molecules. Second, sanctioned systems adapt. You warned about that yourself in March 2025. Overuse sanctions, you said, and the target becomes immune and mutates. Now you are watching the mutation in real time, moving across dark water. If you're enjoying this story, subscribe, because the next move is where the contradiction becomes impossible to hide. On March 13, 2026, the United States temporarily eases some sanctions on Russian oil already loaded on tankers. 30 days. You call it a narrowly tailored, short-term measure to promote stability in global energy markets and keep prices low. That phrase matters. Keep prices low. Listen closely and you can hear the logic of a man trying to split molecules from money. Let the barrel move if the state has already taxed it. Stabilize supply without admitting strategic retreat. It is not clean, it is not elegant, it is triage before the next repricing wave hits consumers and before inflation fear spreads deeper into markets. Then comes the harder admission. The Iranian ships have been getting out already, you say, and we've let that happen to supply the rest of the world. There it is. Not a theory, not a think tank memo, an acknowledgement. And on March 19th, Axios reports your next step. In the coming days, we may unsanction the Iranian oil that's on the water. That is the twist at the center of everything. You begin as the man trying to shut Iranian oil out of the world. You become the man considering how to let some of it through. Not because the pressure campaign was fake, not because the threat from Iran vanished, but because oil markets do not reward ideological purity. They punish shortages. In a crisis, every barrel starts looking less like geopolitics and more like emergency inventory. That is the real lesson of transmission. Treasury can sanction vessels, it can blacklist brokers, it can freeze access to dollars and hunt ghost fleets ship by ship. But it cannot repeal geography. It cannot widen Hormuz. It cannot force captains through a war zone. And it cannot stop a foreign policy decision from coming home through gasoline, expectations, yields, and fear. So the hidden drama here is not just whether maximum pressure on Iran works. It is whether you can squeeze an adversary's oil revenues without squeezing your own citizens at the same time. Can you punish the producer when the market still needs the barrels? That is Scott Bessent's dilemma, and it is the modern energy dilemma too. The battlefield is visible, but the real damage spreads through systems most people never see until it reaches their wallet. If you enjoyed this, please like, share it with your friends, and subscribe.